Question 7. Does FTEC ETF contribute to portfolio diversification? FTEC ETF can contribute to portfolio diversification, but it depends on the overall makeup of your portfolio. Here's a breakdown of how FTEC both supports and hinders diversification. Supportive aspects. Sector exposure. FTEC offers targeted exposure to the information technology sector. If your portfolio lacks technology stocks altogether, FTEC can add a new dimension and potentially benefit from the growth potential of this dynamic sector. Detracting aspects. Limited diversification within sector. While FTEC offers exposure to the tech sector, it concentrates on U.S. companies only. This limits diversification within the technology space itself. Global technology companies could be missing from your portfolio with FTEC alone. Single sector focus. FTEC focuses solely on technology, neglecting other sectors like healthcare, consumer staples, or financials. A well-diversified portfolio ideally spreads investments across various sectors to mitigate risk. Finding the balance. Portfolio allocation. The key to leveraging FTEC for diversification lies in proper portfolio allocation. Consider your overall investment goals and risk tolerance. A small allocation to FTEC within a broader portfolio that includes other sectors and asset classes can enhance diversification without excessive concentration in tech. Alternative diversification strategies. Broader technology ETFs. Explore ETFs that cover a wider range of technology companies, including international players. This can provide diversification within the tech sector while FTEC offers US-centric exposure. Multi-sector ETFs. Consider ETFs that invest across various sectors. These can offer a more balanced approach and reduce reliance on a single industry like technology. Question 8. Are there other ETFs with similar objectives of FTEC ETF, but lower expense ratios? Yes, there are several ETFs with similar objectives to FTEC, Fidelity MSCI Information Technology Index ETF, but potentially lower expense ratios. Here's a breakdown to help you compare. FTEC ETF. Objective. Tracks the MSCI USA IMI Information Technology 2550th Index, offering exposure to U.S. technology companies across various market capitalizations, large, mid, and small cap. Expense ratio, 0.8%, as of March 17, 2024. Alternative ETFs with potentially lower expense ratios. Vanguard Information Technology ETF, VGT, tracks the CRSP US Large Cap Growth Index, focusing on large cap US growth stocks with a significant technology sector weighting. Expense ratio, 0.10%, as of March 17, 2024. Schwab US Technology ETF, SCHW, tracks the Dow Jones US Technology Sector Index, offering exposure to large and mid-cap U.S. technology companies. Expense ratio, 0.6%, as of March 17, 2024. iShares Expanded Tech Sector ETF, IGV, tracks the Dow Jones U.S. Technology Sector Index, similar to Charles Schwab but with a slightly different expense ratio. Expense ratio, 0.8%, as of March 17, 2024. Choosing the right ETF. When selecting an ETF with a similar objective to FTEC but a potentially lower expense ratio, consider these factors. Index tracked. While all the mentioned ETFs focus on technology, their underlying indexes differ. VGT leans towards large cap growth stocks, while Charles Schwab and IGV target large and mid-cap companies. FTEC offers a broader range with its 25/50 weighting methodology that includes some small-cap exposure. Expense ratio. While a lower expense ratio can be beneficial, a slight difference might not be a deal breaker if the ETF offers a more suitable underlying index for your investment goals. Liquidity. Consider the trading volume of the ETF. A higher trading volume generally translates to better liquidity, making it easier to buy and sell shares at a desired price. Question 9. Could a combination of individual stocks or other ETFs achieve a similar outcome with potentially lower costs or greater control? Yes, a combination of individual stocks or other ETFs could potentially achieve a similar outcome to FTEC, Fidelity MSCI Information Technology Index ETF, with lower costs or greater control. Here's a breakdown of the pros and cons. Building a similar portfolio. Individual stocks. You can research and select individual technology stocks to build a customized portfolio. This offers the most control over your holdings and the potential for potentially higher returns if you pick winning stocks. However, it requires significant research, time investment, and carries a higher risk of underperformance if your stock picks falter. Combination of ETFs. You could combine FTEC with other ETFs, targeting different technology subsectors or focusing on a broader range of technology companies globally. This allows for some customization and potentially lower costs compared to FTEC if the chosen ETFs have lower expense ratios. Cost considerations. Transaction fees. While FTEC has a low expense ratio, buying and selling individual stocks incur transaction fees that can add up over time. ETFs typically avoid these fees. Expense ratios. Carefully compare expense ratios of chosen ETFs. A combination of lower-cost ETFs might be more economical than FTEC alone. Control versus diversification. Individual stocks. Picking individual stocks offers the most control but comes with the risk of concentration and potentially lower diversification compared to an ETF. ETFs, FTEC, and other ETFs provide instant diversification within the technology sector. However, you give up some control over the specific companies held within the fund. Question 10. What are the pros and cons of this FTEC ETF compared to similar options? The FTEC ETF, Fidelity MSCI Information Technology Index ETF, offers exposure to the U.S. information technology sector through a passively managed index fund. But how does it stack up against similar ETFs? Here's a breakdown of the pros and cons of FTEC to help you decide. FTEC's pros. Low expense ratio, at 0.8%, as of March 17, 2024, FTEC boasts a competitive expense ratio, meaning the annual fee to manage the fund is minimal. This translates to potentially higher returns for investors compared to actively managed funds with higher fees. Diversification within tech. FTEC goes beyond just large-cap tech giants. Its 25-50 weighting methodology incorporates mid-cap and even some small-cap companies, offering broader exposure within the U.S. technology sector compared to large-cap focused tech ETFs. Passive management. FTEC follows a passive approach, tracking an index. This reduces the risk of underperformance that can occur with actively managed funds if the fund manager makes poor investment decisions. Convenience and transparency. Since FTEC tracks an index, its holdings are generally transparent and easy to understand. Investors can readily see the companies they're indirectly invested in through the ETF. FTEC's cons. Limited diversification. While FTEC offers diversification within the tech sector, it focuses solely on U.S. companies. This limits exposure to the global technology landscape. Sector concentration. FTEC's entire portfolio is tied to the fortunes of the U.S. technology sector. If the tech industry experiences a downturn, FTEC is likely to suffer significant losses, even if the broader market performs well. Passive approach limits outperformance. By passively tracking an index, FTEC forgoes the potential to outperform the market through active management strategies. Limited control. Investors have no control over the specific holdings within FTEC. The fund composition is dictated by the underlying index. Similar options to consider. Vanguard Information Technology ETF, VGT, tracks a large-cap U.S. growth stock index, with a significant technology sector weighting. This offers exposure to established U.S. tech giants, but might lack the mid-cap diversification of FTC. Expense ratio, 0.10%, as of March 17, 2024. Schwab U.S. Technology ETF, SCHW, tracks a large and mid-cap U.S. technology sector index. This provides a similar mix of large and mid-cap exposure as FTC, but with a potentially lower expense ratio. Expense ratio, 0.6%, as of March 17, 2024. iShares Expanded Tech Sector ETF, IGV, similar to Charles Schwab, it tracks a large and mid-cap U.S. technology sector index. Expense ratio, 0.8%, as of March 17, 2024. Question 11. What are the potential benefits and drawbacks of investing in FTEC ETF, compared to individual stocks within the same sector? Choosing between the FTEC ETF, Fidelity MSCI Information Technology Index ETF, and individual technology stocks hinges on your investment goals, risk tolerance, and level of involvement you desire. Let's explore the potential benefits and drawbacks of each approach. FTEC ETF. Benefits. Diversification. FTEC offers instant diversification within the U.S. technology sector. You gain exposure to a basket of companies, reducing risk compared to putting all your eggs in the basket of a single stock. Lower costs. FTEC boasts a low expense ratio, 0.8% as of March 17, 2024, compared to the potential transaction fees associated with buying and selling individual stocks. Convenience and transparency. The holdings of FTEC are typically transparent, and the ETF is passively managed, following an index. This simplifies investment decisions and ongoing management. Lower risk of underperformance. Passive management eliminates the risk of underperformance that can occur with actively managed funds if the manager makes poor investment decisions. Drawbacks. Limited control. Investors have no control over the specific holdings within FTC. The fund composition is dictated by the underlying index. Limited diversification. Geographic. FTC focuses solely on U.S. companies, neglecting the global technology landscape. Limited outperformance potential. FTC tracks an index, so it forgoes the potential to outperform the market through active management strategies employed by some stock pickers. Individual technology stocks. Benefits. Higher potential returns. If you successfully research and pick winning stocks, individual stocks offer the potential for higher returns compared to the market average, which FTC aims to match. Greater control. You have complete control over which companies you invest in, allowing you to tailor your portfolio to your specific preferences and risk tolerance. Potential for diversification. Global. You can include international technology companies in your portfolio, achieving broader diversification beyond the U.S. market. Drawbacks. Higher risk. Investing in individual stocks carries a higher risk of loss compared to a diversified ETF. A single company's performance can significantly impact your portfolio. Higher costs. Transaction fees associated with buying and selling individual stocks can add up over time, especially for active traders. Time commitment. Successfully picking stocks requires significant research, analysis, and ongoing monitoring of the market and individual companies. Risk of underperformance. Even with careful research, your stock picks might underperform the market, leading to potential losses. choosing the right approach. For investors seeking convenience and lower risk, if you prioritize diversification, lower costs, and a more hands-off approach, FTEC could be a good choice. For experienced investors with higher risk tolerance, if you're comfortable with in-depth research, actively managing your portfolio, and potentially higher risk in exchange for the chance of higher returns, individual technology stocks might be an option. Hybrid approach. Consider combining FTEC with a few well-researched individual technology stocks to balance diversification with the potential for higher returns. Alright, Chat ETF fam, that's all the tea on the FTEC ETF. So, to recap, FTEC offers a low-cost way to gain exposure to the U.S. technology sector, with some diversification benefits thanks to its mix of large and mid-cap companies. But remember, it doesn't give you global tech reach, and it puts all your eggs in the tech basket, which can be risky if the sector stumbles. The bottom line? FTEC can be a solid tool, but it depends on your goals. If you're a beginner investor looking for a simple tech play, FTEC could be a good fit. But for a more seasoned investor seeking broader diversification or global exposure, other options might be better. No matter what path you choose, remember, diversification is key. Don't let tech be your only love interest. Spread the love across different sectors to keep your portfolio healthy and happy. As always, this isn't financial advice, so do your own research before you invest. But hey, that's what Chat ETF is here for, to spark conversation and empower you to make informed decisions. Let us know in the comments below what you think about FTC. Is it a friend or foe for your portfolio? And what other tech ETFs are you curious about? Until next time, keep chatting ETFs.